Let's discuss issuance of bonds payable at a premium. When the contracted interest rate of bonds differs from the market rate at time of issuance, the bonds are going to sell for either a discount or a premium. When the contracted rate of interest on the bonds is above the market rate, the bonds are paying a better return on investors' money than the market is currently paying. The bonds will be able to sell at a premium. They will be able to sell the bonds for more than what they will pay back. Let's look at an example. On January 1st, 2019, ABC is issuing bonds. They are $1 million bonds. The par value is indicating how much these bonds will pay. The issue price will be 108.1145% of their par value. They will be able to issue them for more than what the bonds will pay back, because the bonds are promising, they are stating, contracting to pay a 10% interest, when the market, other investments, are currently only paying an 8% return. Investors are going to be very anxious to buy these bonds because they are providing a better return than other investment options. The bonds will pay interest twice a year. The bonds are issued on January 1st of 2019, and they mature at the end of 5 years, December 31st of 2023. The issue price, the selling price, will be 108.1145% of their par value. They will sell them for $1,081,145. The par value, or the amount the bonds will be paying back to investors at maturity, is $1 million. They are being sold for more than what they will pay back. They are being sold for a premium of $81,145. The premium represents a reduction of the cost of borrowing the funds. In other words, they're borrowing $1,081,000 and change. They only have to pay back $1 million. They are paying back less than they borrow. So this $81,145 will reduce the interest that is recorded every 6 months. The premium will be amortized. It will be spread out and decrease the interest expense with every 6-month interest payment. On January 1st, 2019, when the bonds are issued, ABC would record a debit to cash for $1,081,145, the amount of cash received when sold. They record a liability of $1 million. The premium of $81,145 is the difference between the cash received, the liability that must be paid back. We are crediting the premium. The premium is an adjunct liability account. If we were to prepare a balance sheet on the 1st of January 2019, the liability reported on the balance sheet for these bonds would be $1 million. The premium, the adjunct liability account. We haven't worked much with adjunct accounts, but think of it as an add-on. The add-on to the liability of $81,145. Carrying value of these bonds would be $1,081,145. We have 10 interest payments to spread that premium over. 10 interest periods because they are 5-year bonds, and an interest payment is made every 6 months. So we will be amortizing $8,115, which is the total premium, divided by the number of interest periods to amortize it over, 8,115 rounded. Using that straight line method, which amortizes a same or a straight amount every 6 months, the cash payment will be $1 million, 10% interest for half of a year. less the $8,115 premium amortization. The interest expense that is recorded every 6 months will be less than the interest paid to the bondholders due to the amortization of the premium, which is reducing the cost of borrowing the money for the corporation. The entry would be a credit to cash for $50,000, the actual cash paid to bondholders. The premium would be amortized or decreased with a debit, $8,115. Total interest expense recorded is $41,885. Again, notice that the interest expense recorded for this interest payment is less than the cash actually paid due to the amortization of the premium. Looking at a table showing the amortization of the premium over all of the interest payments. The interest payments, or the cash payments actually made to investors, stays the same. It is always $50,000. The interest expense recorded, $41,885. The premium is being amortized and decreasing with each interest payment. The amount recorded in the general ledger for the unamortized premium is going down. By the time we get to the very last interest payment, there will be no more premium to amortize. It will all be spread out over the life of the bonds. The only thing left to pay after the last interest payment is just the liability, which would be a debit to the liability for $1 million and a credit to cash for $1 million.